Well, hello everyone. Welcome again to another free video tutorial. This time, a lot of questions on Forex trading. So this is going to be an introduction to Forex trading. We'll go through some of the main aspects of Forex trading, take a look at a couple sample charts, and hopefully this will answer a lot of questions when it comes to what it is that people are trading that do this, what each significant move means dollar-wise to your account, and I'll go over some of the popular pairs that are traded. So we'll go to the trading hours. Essentially, they really trade 24/7 for 5.5 days of the week. The major currency pairs, there are many currencies, but normally most traders stick to a certain amount. Pips, we'll learn what pips are, and that's the minimum price moves or dollar per minimum price move that you can make or lose. Later we'll look at foreign currency or Forex trading versus currency ETFs, and there are ETFs that track currency. You hear a lot of things about the carry trade or interest rate differential / rollover. Sometimes you can actually make interest or lose interest or pay interest depending upon whether you're long or short a pair, and I'll explain that. And obviously, this is a very active market. It's one of the most active markets in the world, most liquid markets in the world, and certainly ripe for using technical analysis. And of course, managing risk is always important. So before you do any of this, make sure that you really understand it. You understand the risk, how much you can lose. So we think about Forex, and Forex, the market is open 5.5 days per week. And all of these times are going to be in Eastern Standard Time in the US. But if you look at Sunday through Friday, so Sunday afternoon on the West Coast, Sunday evening on the East Coast, the Asian session opens at 7 p.m. And that actually goes till 4 a.m. Europe opens at 2 a.m. Eastern and goes to 12 p.m. noon. The U.S. opens at 8 a.m. and goes till 5 p.m. Now, typically on Sunday nights, the Asia session is really light, and there's not too much activity that goes on there, although sometimes you do see some pretty interesting moves there. The most of the action occurs when Europe opens, and then certainly they call that the overlap. So you notice from 8 a.m. until 12 p.m., the US and Europe, those markets are both open, and Europe and Asia overlaps from 2 a.m. to 4 a.m. Those are really the most liquid times, but Europe is especially important here when that opens up. Now, when we have some acronyms here, you'll notice the USD stands for US dollar, the euro, Great Britain pound, Australian dollar, New Zealand dollar, Canadian dollar, Swiss franc. Those are going to be the designations. Much like if you were looking at a stock symbol, think about this. This is the symbol for these currencies. So if you looked at the Australian dollar, you would see AUD. So this is a market that really trades quite literally around the clock, and just stops at Friday afternoon in New York and then opens at Asia on Sunday night. Here in the U.S., it would be 7 p.m. Eastern Time. So certainly a lot of opportunities for trading. Typically, traders focus on a few of the U.S. dollar pairs, and by U.S. dollar pair, I mean the U.S. dollar against something else, and select crosses. When we say a cross, that's when we see actually a non-U.S. currency compared to one another. And I'll kind of explain this if you're new to Forex trading. Much like, let's say if you looked at a stock like Microsoft or Apple or Google, well, the price of that stock is going to go up or go down. With currency trading, essentially what you're doing is you're taking one currency, comparing it to another, and that's why we see here, for example, that first one, USD versus JPY, that's the US versus the yen. And so we're looking at the exchange rate. And as this pair, you trade it as a pair, or it's quoted as a pair, not the US dollar quoted versus Japan, but it's really the interest rate differential or the exchange rate that you're quoting. And so if you buy a pair or you sell a pair, you're expecting it to either go up in value or go down in value. And I'll maybe explain a little bit more about that later. But here you see the US dollar, the Canadian, the CAN, also nicknamed the loonie, all the way down to the NZD versus US dollar. That's the Kiwi US dollar. And then, of course, some of the cross rate examples. These are non-dollar denominated. So the New Zealand dollar, Japanese yen, the euro, yen, the euro, Great British pound, these are non-dollar denominated, and so we call these the crosses. Now, most platforms, by the way, are going to give you your pip cost. And so I'll spend a little bit of time talking about the pips, and then I believe it's on the next slide. We'll actually go into how to calculate what you make or lose per currency pair. But they are, here we see the example of the euro versus the US dollar. And we have a bid, much like a stock has a bid and an ask price. Here we see it's 1.494 and some change, right? And then the ask is 1.4943. You'll notice here the spread is 2.1. Most currency traders don't pay commission. They simply have to buy at the ask or sell at the bid, and the cost to get into the trade is really the spread. We also see the pip cost is $1. So for this example, there's really the lot size, and there's a lot of leverage that's used in foreign currency or Forex trading. But for this example, we're going to use a mini lot size, which means we are buying or selling $10,000 US worth of the currency pair. The pip is the smallest change in price, and most US dollar denominated currencies, like the euro and the US dollar, they're traded out to 4 decimal places or quoted out to 4 decimal places. You'll see them, like for example in our bid ask here, they show extra places, but the pip is that 4th decimal place. And so if you see the euro US dollar move, if you're long that, and it moves from 1.4940 to 1.4941, that equals a 1 pip move. And if you're long that, you just made $1 if you're using a 10,000 or a mini lot size. If you're short that pair, you just lost $1. Now the US dollar Japanese yen pair, that's priced or traded a little bit differently with regard to pips. It actually only goes 2 decimal places. But again, this is using a $10,000 lot size. And so they're either usually standard, mini, or micro lot sizes. Now, there's a lot of leverage in Forex. It depends on the firm that you're using. It can range from 100 to 1 to 400 to 1. And again, you've got to use proper risk management. I've seen a lot of people go into trades here really enjoying the leverage, and when things move against them, they can lose a lot quick. So make sure that you're using the lot size that's appropriate for your account. A standard lot is really $100,000, and so if you're buying or selling a pair, you're buying or selling $100,000 worth of that. You only have to put up a fraction of that, though, because of the leverage. And so that's why to do some of these trades, you might only have to put up, I don't know, $1,000 or maybe $400 or less to do some of these lot sizes. So that's why people are sometimes drawn to this, the leverage. A mini account, you're buying or selling 10,000 US, and a micro lot would be 1,000. And so the reason why this matters is because your gain or loss depends on the pip, the dollars per pip, right? So usually on a US dollar denominated pair, a 1 pip move is equal to $10 for a standard account lot, $1 for a mini, and 10 cents for a micro. Now, most trading platforms are going to calculate this for you, so you really don't need to know how this is done. But I'll just leave this up here for a second. If you want to calculate the pip size, you actually have to take, and this is a euro US dollar, 0.001 divided by the price times the lot size. So if you're using a mini lot, it would be 10,000 times the price. Notice the difference there if you're using the Japanese yen. And then you've got the calculation here. And when this gets rounded up, you find out that a mini lot, the pip is worth $1. Again, though, most platforms are going to do this for you, so you don't have to actually calculate this. But this is how it's done, kind of behind the scenes. Some of the key data, well, you have the symbol, you have the bid and ask, the spread, and the most liquid currencies are going to have the narrowest spreads. And you'll also see spreads narrow during the most active sessions. Remember, we talked about the euro opening, the US opening, and when they're both open certainly is very important. I'll talk in a little bit about the roll long and roll short. That really is representative of the carry trade, or whether you're making or losing interest. So we'll come back to that. But here we just see this is an example on a trading platform and using the, I think this is a micro lot example here. So I said before that much like if you're looking at Apple or Google or Microsoft or IBM and you look at a stock chart, these are charted as well. The difference is you're looking at one currency versus another, and it's priced at the exchange rate. And so here we see just an example of what that would look like. We see over on the right hand side the prices. And to just give you an idea of the leverage involved here, notice that a move from 1.6778 to 1.8000 is 1,222 pips. So if you were long that pair and you're trading a $10,000 lot size, you would make $1,222. If you're short and it moves up that much, you would lose that much. On a standard account, it would actually be not $1 per pip, it would be $10 per pip. So this would be a gain or a loss of 12,000 and change. That's why it's important to trade the appropriate pip size. Interest rate differentials matter. And here we see, this is from a while ago, but this is actually an example of the central bank rates. And right here you can see the Aussie dollar. The central bank had a rate of about 3.25%. The Japanese yen was the lowest. And so this matters in currency trading. One, because typically if inflation is rising, you have central banks are raising rates, that can impact a move by a currency. But it also matters because you are either paying interest or getting interest sometimes on certain pairs. And so this brings us to the interest rollover or the carry trade. Now at 5 p.m. each day, open positions can either pay or receive interest. One note though, positions, if you're doing something, let's say, on a Friday, or if you have holidays, you can have a number of days where the interest carries and then is paid or received, let's say when the market opens again. But since they're traded in pairs, buying a higher yielding currency against a lower one can result in interest. For example, if the Kiwi dollar and New Zealand dollar has a central bank interest rate of 3% and the Japanese yen is currently at 0.10%, there's a 2.90% differential. And so a carry trade involves buying a high yield currency against a low yielding one. But they also have a high correlation to the general markets and the S&P 500. Periods of greater risk appetite favor the carry trade. Typically when we see the S&P performing very well, the market's humming along, a lot of times you'll see the carry trades do well. A good example of that, this is the New Zealand dollar against the Japanese yen. For a long time, this was a very, very popular carry trade because of the extreme interest rate differential. At one point, I think the New Zealand dollar was yielding about 8% or so, and the Japanese yen next to nothing. And so here we see the chart. Now pay attention to that 9-12 period. That would have been back in '08, and that steep downturn. That actually matched up quite well with the S&P 500 and its downturn. Like I said, the carry trades typically quite often will follow the overall market. Now you can look at using technical analysis. Here we see a MACD study down below. See one of my other videos for really a nice overview on the MACD. But certainly these pairs and Forex in general lends itself quite well to using technical analysis. And just like stocks, they have price bars and they have charts. So here's to the euro, US dollar, the daily. Now the US dollar against the Japanese yen, another example of a chart. And it's a good idea to pull these up and try and spot trends and start to familiarize yourself with many of the popular pairs. A lot of traders even go down to shorter time frames because of the leverage. And a lot of traders trade off, here's a 1 hour chart, you can trade off 5, off 20-minute charts, but it really is completely up to you. So some of the key announcements to watch that will really affect currencies. Well, central bank interest rate decisions certainly, unemployment, inflation, GDP, gross domestic product, retail sales, consumer confidence, really just a few things, but anything that will lend itself to really the health of the economy. That can kind of point out, okay, is a central bank, what are they going to be doing with interest rates? So these are key announcements to watch. Now I mentioned before too that even if you're not interested in trading Forex itself, what you can actually do is there are many ETFs that actually track the currencies. And so, for example, if you wanted to track the euro against the dollar, that first one, there's an ETF that does that. The symbol's FXE. So just a partial list of some of the currencies and some of the pairs. There's some exotic ones down below, even the South African Rand, for example. But if you do want exposure to currencies and you don't want to trade the Forex market, there are ETFs that certainly can do that. So hopefully you enjoyed this quick introduction to Forex trading, some of the main aspects. Please do me a favor and like this video and leave positive comments, and also check out some of the other ones.